Hello, everybody. We are live in a very special edition of Cowboy Metals live stream this Wednesday, August 25th, 2021. Hope everybody is doing well. We are going to get things started. We will let the stream load and we will allow people to get in the stream, let YouTube notify people that we are here. Hope everybody had a great weekend after the Money Metal Summit 2021 that we had last week, Thursday and Friday. We had an absolute blast on that Thursday. We had people come out and stay with us in person. I think we had about 30 people show up to the hotel, and we had dinner that evening. I got to meet and greet a lot of you, talk to you guys in person. It was a whole lot of fun. And then we continued that on Friday with the virtual part of the conference, and had a lot of people attend. I think we had almost 800 people attend, and we had quite a few people attending virtually as well. We had a whole lot of fun. Hope you guys had fun. Today, we're going to talk about the positioning in the derivatives markets and how that may be portending a big price change in gold and silver. We'll get into that data here in a moment. Want to let the stream load and let everybody get into it as well. Hope everybody is doing well today on this Wednesday special edition of Cowboy Metals live stream. Thank you, everybody, for joining. Let's go take a look at who is here. Electrodynamic Orb is here. Thank you for joining the conversation. Thank you, everybody else, for jumping on. We've got about 30 people on. We'll give it another couple of minutes for everybody to join. Just to let everybody know, we are going to do more live streams and more content than we typically do going forward. So I may do these ad hoc and just pop on as we get into the fall season, because in the fall season, we tend to have rising metals prices and lots of exciting news, which we're going to start covering today. Thank you, everybody, for joining. It looks like we're getting the stream loaded. Frank Rizzo is here. John Cook is here. Frank Rizzo, Dr. Doom is here. Good nickname, Dr. Doom. Thank you for joining. If you guys have questions, throw them down in the chat, and we will answer them during the live stream. Thank you, everybody. We didn't do a live stream this past Sunday because we had Steve Mueller on doing a session on uranium, and we followed that up with a Monday session on uranium as well. We believe uranium is going to do really well, so we'll talk more about that as time goes on. All right, looks like people are getting loaded into the stream, so we'll go ahead and get started with the presentation. Hope everybody had a wonderful weekend. We're going to start by looking at the last month of prices. We're going to start right here at goldprice.org. And what I see here is a bit of a schizophrenic market. It's up, it's down in gold. We've had a little bit bigger price recovery in gold this month as a percentage terms than we have in silver. Silver was up today a few cents in trading. Overall gold down today, but these monthly charts indicate that there was a big smash down the beginning of August, both happening at the same time. The first few days, a little bit of a recovery, more gold than in silver, but it's been schizophrenic. So I posted a poll today on Twitter talking about this, and I asked people, gold price has been a yo-yo for the past month. What's causing it? We've had about 272 votes in the last in the first 4 to 5 hours. We'll let this run another day, and maybe we'll get up to 1,000. But it seems as though the overwhelming plurality is schizophrenic Fed talk with 47.4% of the vote. That is talk about tapering. Now, of course, we have Jackson Hole coming up, and we're going to be interested to see what the Fed says there. That's a big meeting of the Fed. Now, they're going to do it virtually this time. They're not going to actually do it in person, I believe was the news. But we'll see, what the Fed's view on the economy is and what news they release. We have the rising dollar index, which was about a quarter of the vote. The summer doldrums, which we expect to be ending now that we're at the end of August, got a little over 10%. And of course, the rising U.S. stock indices over the last month. People believe that may be one of the causes. And of course, we have some interesting comments down here as well. I'll let you guys go to Twitter and look at that for yourselves. I think there could be a couple of other things causing it. I'm going to do a special video this week for my members on the website, members only, which will be talking about 2 of the other reasons I think why we've had a sort of schizophrenic gold price the next month and where I think it may go. All right, without further ado, let's start by looking at the charts. This is the chart that you guys have seen me do many, many times. It is the gold chart. We have the cup formation and then the handle, and then we had a little bit of a breakout from the handle. You can see this opening up here, and then this kind of breaking out into a bull flag pattern. But it hasn't completely broken out. And I think what's going on here is a war between the longs and the shorts, and a lot of speculation going on by the big players in the market. Of course, we're talking the derivatives market, not the retail market. So it's the big players. And I do think we're out of the downtrend in gold, although we don't have a sustained uptrend. That's the long-term chart. Let's take a look at the short-term chart. We'll do about 6 months here to see where we are. You can see it went up and then came back down to the 1800s and hasn't recovered. It's been pretty heavy volume either way. You know, not conclusive either way when you look at the volume. Let's do color volume charts if we can get the reds and blacks. I mean, the reds and blacks are fighting each other, the ups and the downs. We haven't had a sustained pattern. If I were to try to draw something here, I'm not sure, you know, what I could draw on the chart in terms of a trend line. And again, we saw that on the long-term chart, and it's traded, you know, it punched down through this about $1,800 mark, which is a nice support line here, dating back to the last bull market. It hasn't really challenged the 1900 again, which is the high that we saw back in 2011, 1910. It kind of did over here in April timeframe, but the last couple of months it's just been sort of sitting there. So the chart doesn't, you know, it doesn't tell you a whole lot. We have seen increased volume. I did circle that going up to about October of last year, and then it's kind of fallen off a little bit. So we're going to see when we get into the positioning of the trades on the derivatives market, some of this fall off in interest, but all the reduction in the overall open interest, which is the amount of people with contracts on the market. That's open interest, just to define that term. We're going to see how that's kind of been tapering, not only since last October when you had this big volume spike, but especially in the summer. That's partly the summer doldrums, but I think it's also trader positioning. We'll get into that here in a moment. First, let's go to CME Gold. Haven't shown this in a long time. It feels like at least a month since I've gone over this. So we're going to go over it and explain some of the terms here. So we have volume and open interest. Volume is the amount of trades going at a particular period of time. Open interest is an amount of open positions. So open interest is typically bigger than the volume. So open interest, you'll get the line here, and then the volume is the bar. So you see open interest to total positions is more than the volume of actual trades that occurred in that period of time. To explain that, now you've seen since the beginning of August, since we had this price smash down, you saw high volume, meaning there were more short paper positions put on the market. You had the price smash down, and then it's kind of drifted off. And that's why the price hasn't recovered, because the longs haven't come back in and said, we're taking a hard position in gold. I think this is an indication somewhat of the gold, the summer doldrums, but I also think it has to do with the rising dollar index and the schizophrenic Fed talk. And I think the people here about the, let's say 73% of people that answered these two probably have it correct. That's why we haven't seen the longs compound it back in, because you've had a rising dollar. You've also had rising stock indexes, and you've had the Fed talk about tapering, and they haven't been really committal to it. Like, what the hell is going on? Are they going to taper? Are they not going to taper? They've been jawboning back and forth. I don't think they can taper hard. So they do. I think they're going to have a stock market correction like they did in the fourth quarter of 2018. We saw that 20% stock market correction when Powell was trying to be decisive and tighten things up. All right, December is obviously the dominant contract. You can see because of the amount of open interest, as you see here. We go back down to December, 410,000 contracts. That's a lot. So everybody's jockeying for that end of year gold trade. Now, the longs will start to come back in as we approach December, because we expect the love trade, the jewelry trade, the Asian trade to push the physical demand up for gold and silver. So I expect the physical prices to rise just for that reason. There could be some other reasons here too. We'll get into by looking at the trader positioning. Overall, EFP, which is exchange for physical, meaning the interplay or the arbitrage between the COMEX market in the US and the London market, 471, not a large number. Overall deliveries only 8 on today's data, although we'll look at overall deliveries for the month being pretty strong. So let's jump back a trade date and let's see if we had any deliveries. No deliveries. Well, 150 deliveries on the August contract for Monday. On Tuesday, we had 21. Let's go Friday. We had 100 deliveries, as you see here. Let's go down here to Thursday. We had 146. And then Wednesday, we had 0. But I want to show you the overall deliveries here in a moment for the month. I think you're going to find that it's pretty big delivery amount. Now, we're looking at Wednesday's trading data on the volume totals. Volume is the closed trades, not the open interest, but the closed trades. You can see it's down about 1740. So we saw the gold price drift down on the August, September contracts about the same to about the 1790 range. That's about what we're trading. We're trading 1790, 1791. So you can tell that the settlements on COMEX help drive the price. That's part of the spot price calculation, along with the spot price target set in the London market as well. You put those two together and that drives the price. You can see it clearly here on the closes and on the actual price quoted on the market. Pretty conclusive. The derivatives market drives the gold price, and a lot of it is paper. And you can see on the volume that in the December contract, we had a volume of 161,843 closed contracts out of 410,000 total open interest in the gold market. All right. So that gives you the data there. Let's move on to silver. So this is the long-term 12.5-year chart on silver. See the previous high of about $50 hit in 2011, late 2011. And we saw this drift down all the way down here where you had supply destruction, some mines choosing not to produce silver because it was under their cost. And then you saw it pop back up. We had this really exciting pop back up as a result of the silver squeeze. It got to about 30, in which Rostin Benham of the CFTC came out in public at the Boca V conference and said the CFTC tamped it down before it hit 30 using all their policy tools. They tamped down the price and the price volatility and the amount of trading through all of their policy tools. We've covered that on the channel. That is public. It's on YouTube. I'm not making this up. Rostin Benham, interim CFTC commissioner, said he did it using their policy tools, and it's never, I mean, it challenged it here a little bit later, and then it's fallen back down and never recovered. Now, this is the definition of a sideways pattern. There's no bull flag here. We have, you know, as of late, the last couple of months, the price has really drifted down from 28, but this is a straight sideways moving market. It's not a breakout to the top or the bottom. It did plunge down through this number. What is that, about a 24.50 price target, this yellow line? It stayed below there a couple of times. It challenged it once, challenged it twice, and bounced up and challenged it again. That is a bearish sign because you're hitting that line 3 times. At least it's a bearish line on the chart. We'll look at the derivatives positions to see if it gives us any more data. First, let's go and let's do the color volume so we can see the ups and the downs, the reds and the blacks. You can see relatively tepid volumes, and you can see it's plummeted down here at the beginning of August and never recovered. It's straight sideways traded. So if I'm looking at that, I'm like, a little bit of a bear market, but sideways trading. People haven't made up their minds. Okay, let's go to the futures data. Let's go to the trading data and see what happens. And remember, open interest is all the open trades. Volumes is the closed. Open interest is this blue line. Volume are the blue boxes here. And you can tell that we've had some increasing volume, okay? And if you go back to silver price was up a little bit. So that increasing volume was slightly higher or to the upside traders, although not conclusively so. So still in a sideways market on a relatively moderate amount of trading, nothing to write home about. We still have a moderate amount of trading on the September contract, about 42,000 open interest, although about 5,000 contracts came out, and it looks like most of those rolled to December. So you see December got 95,000 open contracts. So December is also for silver, the dominant month on the trading. And let's see what we have in terms of EFP. We had 750 EFP as of Tuesday's trading data. They haven't posted, interestingly, Wednesday's trade data for silver like they did for gold, but 750 EFPs. That's the arbitrage play between the American market and the London market. And in terms of deliveries, only 11 on the August contract. We go to Monday. We had 13 deliveries on the August contract and 525 EFP. None of this, anything to write home about. Silver, there haven't been a lot of deliveries this month. I'll show you that in a minute. The EFP's 485, deliveries 25. So not a lot going on this week, at least the last few days and leading back to last week. Let's go look at the settlements and see where the price is moving. When you look at the settlements, you can see silver was down in late trading. It says here silver overall is up. That's after basically the close of this trading and then into the global market, but overall slightly down to about 2380. You can see the dominant month was December, 32,000 contracts closed there. 55,000 contracts closed in September. Even though December is the dominant month, people are closing out their contracts in September to roll to December essentially, or to take their positions for December, which is overall an open interest perspective, the more dominant month. All right, that's it in terms of what's going on in the futures and in the prices. I'm going to drop out a share screen and see if we have any questions in the live stream for everybody. Ooh, looks like we have a lot of people going, 153. Peter Langvin is here. Chase Wilson is here. G-Dog Bull is here. Frank Cerveni is here. Gastorfic Muncher, I love that name, is here. Dumb Money Media. Rock On is here. Big supporter of the program. Thank you so much, Dumb Money Media, for your contribution. He asked, do you think more companies will follow the lead of Palantir over the next few months? The mainstream downplays these large buys of gold. Yeah, I think Palantir in particular, due to their political connections, knows what's going on, and they're buying gold as a crisis hedge. I think that's 100% true. I think they see the agedness of the market 100%. We could see some other companies do this as well. It would not in any way, shape, or form surprise me. Good question. Sarge says, Mr. Keynes, thanks for the sharp eye. You're welcome, Sarge. Thank you so much for joining. So many more people here. Craig Trout, The Reign of the Zero, Keller's Cars, Kenneth Martin, G-Dog Bull, Matthew Hartley. Thank you so much. Matthew says, love for you to analyze SLV in Australia. Huge silver play movement production. Oh, SVL, I'm sorry. Okay, I'll take a look at that ticker maybe at a later date. Thank you so much. Let's see if there are any questions. I'm scanning. Okay, Frank Cervini has a question. How big of a gap can possibly grow between spot and the premium? Frank, when there is a run on the physical, because people are worried about it, the premiums can blow the hell out in the retail market. And essentially, if there isn't enough metal at current prices that the big holders on the big exchanges and the big banks want to get rid of it, you can say huge premiums. They can go as high as you want to go before those premiums cause the big holders to start dumping. Okay, or the relatively weak hands to start dumping. Of course, you're always going to have the strong hands that aren't going to get rid of it until it pops a much higher price, or they're using it for industrial purposes, so they don't care about short-term price movements. But yeah, there can be a big gap. Good question, Frank. Thank you for answering it. Kristen Rowe is in the house. We got to meet her in person at the Money Metals Summit. Had a really good time talking to her. Glad she came down from Alaska. Good to see you. Hopefully that's not the last time I see you, Kristen. Come back and see us in the Dallas-Fort Worth area again, please. It was a pleasure talking to you. Let's see, any other questions? Chase says the market's going to drop. Wait for the cyber attacks that will hit the stock market. That could be true. When that's going to happen, Chase, what's your opinion on when the cyber attacks are going to hit? Please put that in the comments for everybody else. Would love to see those comments. Let's see if we have other questions. Oh, sorry for your torn rotator cuff, Brap. I'm not seeing other questions, guys. Let me scroll through. Oh, do you think the Fed will ever taper? Farmer Dude 357. No, I do not, until they're ready for the market to really tighten. They're ready to pull the liquidity out of the market. Now, could they try? Sure, but you're going to have instant stock market correction. So if they don't want stock market correction, no, they will not taper. And I think if they taper too much, they could crash the economy. We'll have to see what happens with the worldwide lockdowns due to the Delta variant. We see in Australia and the UK, they're doing more lockdowns. We see the news coming out of Canada. We'll have to see what happens to the US and the European markets. If they start to lock down, the Fed cannot taper. They're going to have to go more to easing, because they're going to have to offset the deflation from a lockdown economy, the economic deflation, the production deflation, not the monetary deflation, but the production deflation. Done many media, how the job market out there, I'm looking to move. And Dallas-Fort Worth, it's actually really solid. Texas is a pro-business state. Even though we have tons of people moving here, a lot of companies are moving here also, so the job market's pretty good. Of course, that depends on what you're doing. I have a couple of college degrees, so for me, it's pretty good. Depending on what you do, if you're a tradesman, I think it's pretty good as well. I don't know what you do, but I think it's pretty good. All right, we're going to get back in the presentation. Thank you so far for the questions, guys, and Dumb Mini Media for the 2 contributions. We definitely appreciate it. Let's get right back into the share. So I think I left off with the CME silver data. Let's go to the COT report. So this is the commitment of traders from the CFTC, the regulator. This is August 17th data, so it's about a week old. In a couple of days, we'll get the new data. We're going to go right down here to silver, and we're going to analyze this line right here. So let me blow this up just a little bit so you guys can see it a wee bit better. All right, I think that's good. So we're silver, and if you look at the producer merchants right here, you see that their net positioning was to go long about 1,300 contracts. The swap dealers or the bullion banks was to go, net long about 3,000 contracts. So the bullion banks are really dumping their shorts and going long. Aha, we'll talk about that in a minute. The managed money is going net short about 2,000 contracts. So they're taking the other side of the bullion bank trade. That's normal. And overall, the other reportables are dropping overall positions, but they're going net short about 1,200 positions. So negative about 666. This is an interesting number. About 666 overall closed contracts on the market net of long and short positions. So overall closing positions, 666. 6. Could that be significant in any way? I don't know. I'll let you guys answer that in the chat. Here's gold. Gold is a wee bit of a different story. You can see the open interest is actually up 8,200 contracts. So people are dumping overall the derivative positions in silver. They're adding a whole hell of a lot of positions in gold. So let's look at this line right here. Net, the producer merchants are going short to the tune of about 4,000 contracts in gold. So they're expecting price to fall. Look at the swap dealers. Net short of about 14,000 contracts on gold. Wow, that is a huge amount. That's like 7 or 8% in 1 week. Bam. A lot of shorting going on gold. Maybe that's why gold got hammered in August, and a lot more short going in the past week. And that's why you see that sideways trading gold price, because they're dumping net of about 14,000 short contracts. Now, the other side of that is managed money. They're net going long, oh my gosh, about 23,000 contracts, and the managed money net going short about 600 contracts. So the majority of the contracts added long were the managed money and short were the swap dealers. The swap dealers expect the price to go short. Managed money expects it to go long. Guess which direction I think it's going to go? Not too hard to figure out. All right, now we're going to go to bar chart, because bar chart has a nice trend for us. Here's the price, but I want to talk about these positions down here. This bottom half of these squiggly lines. This is what you want to watch over time. If you look at what's happening, the other reportables, which are the wealthy family offices and individuals, have gone net long. Look at this jump up in August. They went net long. Either they're wanting to take delivery or they expect the price to rise and they're speculating gold up. These are wealthy, smart individuals. Pay attention to that category. It matters. Now, and almost an exact opposite, look at this, an exact pattern, the opposite direction, okay, is the managed money. The managed money, the hedge funds, the dupes in the gold market, if you will, are going net short. They're expecting the price to fall. I would follow the other reportables before I'd follow the managed money, the hedge funds. The other reportables are always smarter when it comes to gold, at least when they want to take delivery and speculate a bit to the upside doing so. The swap dealers, the bullion banks, have reduced their short positions. Look at that. They're expecting gold to rise along with the other reportables. And the producers have gone net long as well a little bit. See this little pop here? So most of the categories are going long in gold with the exception of the managed money. The managed money are always the dupes. So that tells me over time, regardless of what happened last week in the COT report, over time, people are expecting gold to rise. Why? You've got the love trading gold coming up in the fall. They're positioning for that rise. That's what's going on. That explains why people are net dumping shorts and going long, except for the managed money, who are always the dupes and always the people that get taken advantage of in the precious metals market. Now, how does that happen? How can the managed money over and over get taken advantage of? Because managed money represents all these passive funds and all of these actively managed funds that will do the little bit of exposure in gold. And so if they lose money, they just go tell their clients, oh, that gold, it's that fault. But their clients overall are okay because they're balanced by other positions like stocks and other things like that. That's how managed money can always lose, because there are literally thousands of millions of people's money aggregated up into these big funds that if they lose a little bit on gold, it doesn't necessarily hurt them over time, as long as they're offset by other winning positions and other passive funds. So as long as that stock market's going up, I know that this is the translation or the summation. As long as the stock market's going up, the managed money can lose a little bit of money in gold and it's not going to affect them. That's why they're always going to be the dupes in gold. And that's how the wealthy families, other reportables, the swap dealers, and the producers can take advantage. That was a good question I got asked at the conference. I want to make sure and answer it. That's how managed money can always lose money, because there's literally billions of dollars going in there, a little bit to everybody's account. And if they lose on the derivative trade, it's okay. They're not going to die. And that's how the swap dealers, the bullion banks, and the other reportables take advantage of them and take money. As long as that stock market's rising, they'll take money off the gold trade from those idiot hedge fund managers. Sorry, hedge fund managers, but you always lose in gold. When it comes to gold, you guys aren't that smart. I'm sorry. It's just what the charts show me. All right, now in silver, what's going on? We saw in gold how you had the rising 3 of the 4 categories, the smart categories, expecting long gold. What do they expect in silver? Let's look down here as well. What do they expect? The first thing I notice is managed money going short. That automatically tells me the rest of the people probably think it's going long. Look at the lines. The swap dealers, the bullion banks, the really smart guys, and the producers are going net long. and the other reportables are just staying straight across. That tells me we probably have a rising silver price, but somewhat less than the expectation for a rising gold price. Rising silver, somewhat less, because you have about even with the super smart money, the other reportables, the really smart guys. You have the bullion banks reducing their shorts, expecting silver to rise. But the producers overall are, so I'm expecting silver to rise maybe somewhat less as a percentage of gold going into the fall, okay? With the managed money taking it in the shorts again, because they're going net short, expecting it to fall. So the managed money is going to get taken advantage of. It's going to go up, probably somewhat less as a percentage than gold, at least based upon this trend in August right here. Net, people expecting again over the month, silver to rise going into the fall. Remember, precious metals rise going into the fall. You have the love trade in gold and silver. It gets demanded more as we build up to the holiday season and the love trade in Asia. People want more silver, more demand. Physical demand means a rising price. You see the positioning in the markets, okay? This is a big seasonal trade coming in gold and silver. That's why I'm emphasizing the positioning on the derivative market, because the smart people know what the hell is going to happen. And so you guys know is what's going to happen. And that's why I document it for you guys. All right, now we're going to drop out, go back and answer questions. And then I'm going to get into what was actually delivered, which is really interesting. We'll do that here for just a moment. Let me go back and see what questions we have. All right, no super chat. Remember, super chats are open if you want. Let me see if I have other questions from you guys. Oak is here, Gator68 here, John Bethea is here. When the miners are in contract with companies before it hits the market, what will this lower the stock price? When the miners are in contract with companies before it hits the market, will lower this? Not necessarily, because think about it. If the miners are selling forward all their production and it's guaranteed sales, even if it's slightly lower price, that helps their balance sheet. That will help their overall income on the quarterly statements. That should cause the miners to go up a little bit, the miner stock prices to go up a little bit. G-Dog Bull says, Rob, what are your thoughts on Stream's contract with startup junior miners? Now, if they're a startup junior miner, that's very speculative, because startup means they may not know what they have in their deposit unless it's a past producing deposit and they have a prior period 43101 from a prior mining. Now, if they don't have a prior period 43101 resource estimate or prior production on that project and they're a startup, then it's really risky because you don't know what the hell they have. And at that point, you're basically gambling. So it depends on the particular situation you're getting into. Sarge says, Rob, what if a big fat silver whale gets FOMO and stands for delivery? That could happen. Now, the silver deliveries pretty much all year have been fairly tepid off the COMEX. Now, if they really want it and they stand for delivery, yeah, that could spike the price. We saw that, last year when I started talking about silver and I predicted, I think it was July 14th, I predicted it would rise and a couple of days later it did. That's because we saw some of those big players taking a bunch of delivery. So we could see a replay of that again this year, but you got to start seeing the delivery numbers and we're not going to see it. We're going to show you that in a moment. So I don't think it's happened yet. We'll see. Going back to the share, let's talk delivery numbers. All right, so here is the month-to-date delivery notices. You'll notice as we get to gold, bam, look at that number. First intent date for August, which was done on July 29th, we saw 14,526 contracts delivered. Next day, 3,100. For a total so far this month of 25,000. That is a big gold delivery month. Okay, notice we go back to gold. Let's go back to the short-term chart. I want to show you guys how the players take delivery of gold super cheap. Look at the beginning of August. Price smash. Okay. Price smash and gold price. Crap ton of physical deliveries. They smash the price. They take delivery. Then they let it rise the rest of the month. Okay. Smash the price. Take delivery. Let it rise. Okay. That's how you get the gold out of the system at a cheaper relative price to what it's been trading at. Okay. Go back. Price smash, big delivery, okay? Price smash, big delivery. Not rocket science there, but this has been a big delivery month, and that's how the big dudes get it off the market. Now, we saw the positioning of them going net long on the contracts for both gold and silver. So they took delivery cheap, and now they're expecting the price to rise. They're going to make money on the rising derivative price. That's how the bullion banks and the other reportables, the super wealthy, play this market. They're smart. Okay, we see this time and time again. Now, what about silver? Let's go talk about silver. We'll go down here to silver futures. Nice little delivery on the first day, 1,629 contracts of 5,000 ounce. It's a fair amount of silver. It's fallen off a little bit. So silver, they're not taking as much off. Maybe these the industrials wanting it, maybe some investors. It's not as pronounced as it is in gold, like as a percentage of, the open interest and the deliveries, and dollar wise, certainly, but there's a fair amount. Okay. But I don't see the big whale, to answer Frank's question before, I don't see the big whale in here taking big delivery. Just not yet. Could it happen? Sure. It's not going to happen in August. The next big trading month is September, but those contracts are starting to roll to December. So could it happen in September, a big whale? Yeah, it could. Even though you have open interest falling, there's enough contracts for a big whale to come in that are open. Yeah, you can take delivery in September, but more than likely that would happen in December. Moderate chance of September, I would say like a 25% chance of a big whale. December, probably more 50-60% chance. And it could happen in intervening months in October and November, and then it's very thinly traded months. It could happen, much more unlikely. All right, now getting into, this is really interesting because you get to see the depositories which are issuing and stopping the contract. Issuing means you're giving up the metal, stopping means you're taking the metal, and whether it's on their customer account or their house account, their own trading account. So the big number we immediately see in gold, this is gold futures as of August 24th, is Goldman Sachs. So 5,900 issued, meaning they're giving up 5,900 contracts of gold out of their house account. The next big number you see is Deutsche Bank. It's about even issues and stops, not a big deal there. And then the next big issuer is Macquarie Futures, 3,200 contracts in August. And then we scroll down, who's stopping, who's taking? Standard Chartered Bank. And their house account is taking 3,457 contracts. They're taking the physical. Okay, 3,457 contracts at 100 ounce gold. Who else is taking? Scotia Capital, issuing, taking, 100 difference, not a big deal. BNP Paribas, issuing 400, they're giving. Who's taking? Morgan Stanley, out of their customer account, giving 1,449. See, customer account, issuing means giving, 1,449. Net JP Morgan, out of their customer account, is issuing and taking the difference of about 2,700 contracts. So they're taking more than they're giving. But look at their house account. They ain't giving nothing. They're taking it all. So JP Morgan, the house account, trading for themselves, is taking almost 4,000 contracts of gold, and they ain't giving squat. Now, they are giving away out of their customer account, but they're taking more. They're servicing their customers and getting more physical delivery. But for their own account, they're getting a crap ton of physical delivery. And ABN and AMRO, it's an even amount of issued and stopped. So net, not much. Now, Barclays, they're issuing 1,386 out of their customer account, customer here, C, but they're taking 4,019. So net about 2,700 contracts. So JP Morgan, Barclays are taking more than they're giving. And then also Standard Chartered Bank. Standard Chartered Bank, JP Morgan, Barclays. They're the ones taking delivery through their depository. And then Citigroup was giving up 2,000. That's a fair amount. And that's it. So a few givers, a few takers. That's the report for you. So going back to the beginning, why are gold and silver smash down physical delivery? Remember, smash down, take physical. Smash down, take physical. More so in gold than in silver. What's causing the price down? The doldrums, schizophrenic Fed talk, sure. Rising dollar, sure. Stock indices, sure. What else? I think I've explained it. But again, we'll have more on that for subscribers. Subscribers, wait for that information. We'll have that coming up for you. Oh, 250 in the stream. Good to see, guys. Thank you so much. Matthew Hartley gives a nice donation there. Thank you so much, Matt. He says, hey, Rob, love your work. Thank you. SV Australia is a huge silver play moving into production 2 to 3 months from full approvals. Love for you to analyze the company for you. Matthew, I'll do that. Stay tuned for that on an upcoming stream. Or if you email me, Robert Gold Silver Pros, that may be a better way to do it. I'm not going to do it today because I like to take my time on doing that. I want you guys sitting here for a couple hours while I comb through stuff. But send me an email, Robert at Gold Silver Pros. Let me know that you came in the live stream and you asked this question. I'll answer it for you there. If I don't see an email, I'll try to remember on one of my next broadcasts to answer it for you, okay? Appreciate you doing that donation. What other questions do we have? G-Dog Bull says, Rob, with the political situation turning more communist in Peru, is it reasonable to expect nationalization of the mines and reduction of production due to lack of foreign investment? Okay. Here's my thing on Mexico and Peru and the recent elections and the swing left, politically meaning. We haven't seen them actually try to nationalize a mine or hamper that mining industry. Why? They need money. So for all their social programs, mining is big in both Peru and Mexico. They need the money. Could they try to nationalize it? Yeah. The problem with nationalizing is you're going to fuck it up. You're going to fuck up production. You're going to fuck up everything. You're going to get less money. Could they try? Yeah. More than likely, what we've seen in Mexico is some additional taxation and a little bit tighter regulation and control of, say, the contractual agreements to get more money. I think you'll see that in Peru. I think you could see some higher taxes. You could see Peru state get warm and fuzzy with the miners and kind of watch what they're doing and make sure they're following their contracts and, stricter, tighter rules, for example, to influence, the miners' contributions to the government. Straight out nationalization, no. They would be stupid to do it. I think they would have things up. Could they? Sure, if they're nuts. But at some point, you got to let the mining companies pull the metal out of the ground and just make your money off the back end when they get the metal out. Or as they go for additional drilling permits and additional production permits, change the terms of the agreement and get it that way. I mean, there's all ways to do it without effing it up by trying to run the thing yourself. And I think some of these leftist governments have figured that out. Stop trying to screw everything up. Let the miners get it out and you just get your money on the back end. That's another way to do it. And to me, if you want more money, you do it that way. And to be honest with you, whether you're a left or right government, if you see your natural resource being mined and you want more of it, i.e. Indonesia, did to Freeport-McMoRan and Grasberg, you can make it to where the agreements are where you get more local workers and you get more taxes. Therefore, you're capitalizing more on your natural resource. There's nothing wrong with that, as long as they're not overdoing it and putting the mining company out, because the mining company has to make the investment, right? But I think that there's room for some of these nation states to get more out of their natural resources and work with the mines and do it in an equitable manner for everybody. So the investors don't get screwed and, the local governments don't get screwed. And I think that's negotiable and that's okay. Now, if you're going to go and nationalize a mine, it's probably going to be because of war and you're talking about you need certain base minerals or silver because it's industrial. I could see that. Now, nationalizing the gold and silver mines just because you have more of a leftist government, that to me is stupid and we haven't seen it happen so far. So I don't think at this particular moment is as big a risk. Now, that was a really long answer, but I get that question a lot, particularly with Peru and Mexico. So I wanted to spend a long time answering it. Rob, have you ever used volume profile in your technical chart analysis? Volume profile. Yeah, I look at volume. Volume matters, but with the amount of open interest, or if you're talking about derivatives, if you're talking about stocks, have I looked at it? Sure. Volume matters a lot. Volume matters when you're talking about a run one direction or the other. Volume can tell you how the players are seeing something go, and you can look at it and say, okay, here's a move in volume. What does that mean? The net of what the traders would think is going to happen. Yeah. So that's trader positioning. The volume is trader positioning at a particular point in time. That's absolutely important. Let me see. Give a big like all. Thank you so much for that comment. Rob with the political station. No, I already answered that from G-Dog. Any other questions? I don't see any other questions, guys. Since we don't have any other questions, I'm going to do one more share and I'm going to talk about Skillshare, who is a sponsor of the program. This will be really quick, but I think you guys might get a kick out of this. This is a video I did. Let's go ahead and do that share and play it for you now. This will take only a moment. I took a recent class that I wanted to share with you because I think it applies regardless of whether you're an entrepreneur or you're trying to figure out your career or whether you're trying to make a career move. The class that I took is called Creating Your Dream Career, Uncover and Apply Your Creative Strengths by Holly Murchison. And it's a really great class. And the one thing I love about the Skillshare platform is it has great classes for other creatives like myself that also focus in on fundamentals, doing fundamental things that help you shape your career. And that's exactly what this course was about. She talks about in this course her past history and figuring out what she had joy in and what she loved to do, and then applying that to where she wanted to go. So exploring your past is a big part of figuring out where your future may be, and then acknowledging what's present, acknowledging the skills that you have, such as communication, public speaking, business skills, and how you would utilize those skills in your present to help shape your future, as well as understanding what your responsibilities are. You may have certain responsibilities that you have to meet, but you may be able to change your career or your entrepreneurial path to meet those while also allowing you to do what you love. And envisioning your future, she said the first thing that she did was she wrote down her goals of what she wanted. And immediately when she wrote them down, the opportunity to do her video for Skillshare manifested. And that manifested her dream of teaching to a wider audience instead of doing her one-on-one coaching. Something that I definitely have experienced in being a YouTube influencer and through social media that I greatly enjoy. So I can definitely emphasize with her on that. And also charting a new path. Writing it down, speaking the goals that you want, deciding which skills that you want to use most over the next year, and then plotting a path to doing that. Charting a new path is one of the sessions in our video where you learn to take what you want to do, chart your path, start working on that bit by bit on an everyday basis and building your future. The greatest thing about this video was a line that she had in there about envisioning your future and watching it come true in front of you. And I believe that. I believe if you speak it, you can achieve it. And you just need to plot out what would be the best path for you. This training session by Holly was emphasizing the views that I believe and also providing me some additional methods for plotting out what I want my future path to be. It's been very successful for me in becoming an entrepreneur and launching my new life in what I do. And I've had such great joy in it. And I share in that joy with Holly. I think she has a great presentation. For those of you interested in Skillshare, if you want to plot your new career path or maybe your new entrepreneurial path as a business owner, I highly encourage you to watch this video by Holly called Creating Your Dream Career, Uncover and Apply Your Creative Strengths. And to do that, you would just sign up for Skillshare. People that sign up to Skillshare below will get a free trial. So please try that out. The link is below in my profile. And I hope that you enjoy Skillshare as much as I do. It's really designed for creatives. There's new content out every day. They have hundreds of videos for people like you and me that are trying to explore what we want to do with our lives and to have and live a happier future. The first 1,000 people to use this link will get a free 1-month trial of Skillshare. Awesome, guys. So that was my little commercial message for the day. I want to thank everybody for joining, and I wanted to sum up exactly what we talked about on the video. Remember, people are positioning for the love trade and the coming rise in precious metals prices that you're going to see throughout the rest of the year. We saw the net reduction in shorts in both gold and silver, and the hedge fund managers are going to take it in the shorts as they always do. I explain how that can work and how that can continue to happen because it's spread out literally amongst millions of people that have money in these passive and actively managed funds. And that's how the bullion banks and the other reportables do it. They take advantage of these guys. And as long as those losses aren't higher than what you see in the gains in the overall stock market, this can continue forever. And that's basically how that works. Thank you, Sarge Rob. Thank you for your hard work and many, many eyes to manipulation. You are welcome very much. Yes, there was some manipulation talk here because I think it is manipulated and I think it's to make money. And we haven't even talked options. We could talk option markets and how you can cause people to hit their certain stops or values in their options and to make money on the other side of it. The bullion banks do that too, and the managed money does that too. But all we really have to do is look at the derivatives trade, the futures trades, and you can see, how it occurs. So wanted to cover that. I hadn't done it in seemingly forever. Great to do on a live stream. Great to talk with you guys here. Thank you, guys, for your contributions. Dumb Money Media, Matthew, appreciate that. Thank you, everybody, for your questions. I think I'm going to go hop out and have a little bit of dinner, but fully encourage you guys to take a second look at this video. We'll have more content throughout the week. I've got my team working on taking the videos for the Money Metal Summit last week, for those of you who couldn't attend, and putting it to YouTube playlist. That will start to occur in the next couple of weeks. There's a lot of work to do that, but we'll start to release that in the next couple of weeks. Had a lot of great roundtables, had a lot of great conversations for those of you who invest in the mining stocks, had a lot of friends show up. It was really fun. And we had a really fun after-hour session where we brought people up on stage, a couple of our super fans, Michael and Steve, as well as some other people that we wanted to have there, and answered questions for people locally and online as well. So stay tuned for that. We'll have the conference up in the next couple of weeks as we get those videos processed. Thank you, everybody, for tuning in today. I appreciate it. Stay tuned for more content this week and more precious metals analysis. The overwhelming number one ask I got at the conference is, Rob, go back to precious metals analysis. So we'll cover macroeconomics, but we're getting back into the daily precious metals analysis because you guys asked for it. Appreciate it so much. Thank you so much. Good night, everybody. Have a good rest of the day, and we will see you tomorrow.